Instead of putting 20%, let's put down 10%. Let's take that other 10%, pay down on these credit cards, get your credit scores up to 780, and now your interest rate is going to be a half a point better, and you're going to save $50,000, $60,000 over the life of the loan.
Hey, Eddie. So a lot of my clients have less than stellar credit. So tell me a little bit about the credit qualifications for these loans. What does that look like?
Well, typically what you're going to need when you're qualifying for a loan is your standard is going to be anywhere between 620 credit score and over 780. Anything over the credit score of 780 is going to get you the best of the best of the best. It doesn't matter if you have an 825 or a 785. Anything over 780 gets you the best. Now, every tier below that drops by 20 points, so 760 to 780 and 740 to 760, your rate is going to move up a little bit. When we start dropping below 700, then that rate starts really moving up. The cost for mortgage insurance really starts to move up. And that really makes a determination as to what type of loan program that we may possibly do at that point. If you've got a 800 credit score, then it's very likely that what we're going to want to do is more of a conventional loan, simply because you get all the benefits, right? Mm-hmm. If you have a credit score that's 680 or maybe even a 620, then we're definitely going to want to look at more of an FHA loan. And the reason for that is because it's much more forgiving on not only debt to income ratios, mm-hmm. but their credit score requirements that will allow you to not get so adjusted with the interest rates on stuff like that. So now they do allow some loan programs that'll go below a 620, but the parameters there tighten up a lot, right? The qualifications become much more difficult. At that point, an underwriter has to be a lot more strict. They have to look at it and scrutinize it a lot more. And if you've got some credit problems in the past, if they're recent, within the last 12 months, that could be a determination whether or not you actually are going to qualify or get approved for the loan on something like that.
Yeah. Is there any ways to or tips and tricks on how to quickly increase your credit score?
Yeah, there is. I mean, one of the things that I do once I look at your credit score and I see, okay, well, they're at a 680 credit score or a 660 credit score, but I'm looking through that, they're not late on anything, right? So I would first then look at, well, what are their limits and what are their balances on their credit cards? If they're maxed out or close to maxed out or something like that, then their credit scores are going to drop. So it could be, and this would be some advice that I would give them, right? Maybe they're putting 20% down and they've got a 680 credit score. Well, instead of putting 20%, let's put down 10%. Let's take that other 10%, pay down on these credit cards, get your credit scores up to 780, and now your interest rate is going to be a half a point better, and you're going to save $50,000, $60,000 over the life of the loan. So there's little things like that. I also do work hand in hand with a credit repair company that is owned by a group of attorneys. So it's a little bit different because they know all the laws as it pertains to, fair credit. And, they can help a person. It's usually a 6-month program if they've got a low 500 credit score to get them up to where they qualify to be over 620. So, there's all kinds of different things that we look at as to what we can do before we just say no. Yeah. Right.
So you keep on saying credit scores. I know like Credit Sesame, Credit Karma, not sponsored. They always do things like, oh yeah, you can just log onto our website and we'll tell you what it is. Is that actually the credit score, or what do you use as a credit score?
That's such a great question. Yeah, that's a great question because I have that all the time, right? A consumer score is way different than a mortgage report, right? They go off of 2 complete different algorithms. It's a good gauge. It really is. So, I mean, if you tell me that, Eddie, I'm looking at my Credit Karma, I've got an 805. Well, good credit is good credit is good credit, right? So when I pull your scores, you're probably going to be somewhere close to that. But if you tell me, Eddie, I've got a 705, I'm a little concerned that when I pull your credit report for the mortgage, because of the algorithm that has more criteria built in. How old is that account? How do you pay your account? Do you pay the minimum payment? Do you pay it all off in full? How are these things are brought into effect at that point in time? And then when we look at that, your scores might be quite a bit different. So for me, it's a good gauge. I always ask them what their credit score is, what they've seen. And then I explain to them what I'm going to pull is going to be different. and I explain to them why. But it really is a little bit confusing because most people, when they are looking at their credit card that gives them a free credit score or something, it tells them one thing, and then when I pull the score and it's different, they get pretty confused. So I try to meet that at the pass and let them know from the beginning what's kind of going to happen, when I pull that score. But I can tell you that when somebody tells me what their credit score is, let's say they say that I'm at a 640, I immediately know that there's something going on. They've either had some late pays, they've got very high balances, they've had a couple collections, either all of those or one of those three that I just mentioned. So then I start to have a little concern and then might need a little extra work in there before we're able to turn them back over to you guys and go find them a house.
Do you keep on saying pulling credit scores? Is that a hard pull, soft pull?
Well, in order to get through underwriting, it has to be a hard pull. Okay. Now, Josh, I'm so glad you brought this up because this has been such a pain in the butt for so many people. Experian now sells, the moment that I push the button to pull credit, Experian sells the fact that I just pulled a mortgage report to everybody on the planet, and within 20 minutes you're getting 30, 40 phone calls. Okay. So what we have done in our industry now, and it's a little bit more costly for us, but to avoid that, is we pull a soft pull so we know what those scores are. It doesn't register as a real inquiry. And at that point in time, what we do is we get it through underwriting. We still have to pull a hard pull, but we pull it towards between the middle and the end, to where when those phone calls do come in, it's not going to be a disruption to the process. Right. Number one. Number two, on my email signature line, and I tell everybody this, there's a link to the opt-out website. And that after we get done talking, it say, hey guys, click on that link below and opt out of all this. That's going to take 7 to 10 days to go through the system, but it should minimize on those phone calls.
Okay, so once you have issued the pre-qualification, how important is it for the consumer to maintain their credit from that point to when they close on the property?
It is absolutely crucial. That's what it is. Okay. So once we pull the credit report, that credit report is good for 90 days. Okay. All of the underwriters, all the lenders have to use my report, right? So they're not going to pull another one. But what they do is they put a monitor on your credit. So anything that you do, they will know. If you go and apply for credit, they'll know. If you go and charge something on an existing credit card and all of a sudden your balance goes up by $10,000, they're going to know.
Buy a brand new car.
Miss a payment, they're going to know, right? And if all of these things happen, or any of these things happen, they will mandate that I pull another credit report. So it is very, very, very important. And a lot of times what happens through the process, and unfortunately, it doesn't matter how many times you tell a consumer, hey, don't do this, don't do that. A lot of times people are going to do it anyway. And what happens is they get notified that an inquiry was just reported to the credit. And the lender then stops and says, we need to know what that inquiry was. And we need to know whether or not they actually took out a loan or bought something, what those payments are, what are the terms of those. And we've got to supply that. And if we don't supply it, the loan doesn't go through. And when we do supply it, let's just say that whatever they may have done, whatever that payment is, now has to be added into their debt to income ratios. So how important is it? Direly important, right? You don't buy something. Don't have your credit pulled. Don't buy a new car. Don't do these things.
What about
maintain?
Jobs? What about your job?
Oh my God. Oh my God. Yeah, don't quit your job.
Don't quit your job.
Don't quit your job. Don't change jobs if you can, right? Yeah. I mean, sometimes you can't control that. You know, something comes along where you got to change or get transferred. You know, we can work through those things, but by all means, don't quit your job and don't get fired. So, yeah, there's a lot of different things. Play nice. Yeah. You know, it's 30 days, right? Whatever your plans are, hopefully they can wait those 30 days. If you're going to furnish your house, wait until you close, right? And I'll give you the thumbs up. So great questions, guys. So anyway, if you guys enjoyed this video, please subscribe, follow us on all of our social media, add some comments below. And we look forward to seeing you on the next one. Thank you.